PepsiCo might not make headlines like AI stocks or tech giants, but it quietly generated over $90 billion in sales last year, pays a growing dividend, and has increased payouts for more than 50 consecutive years. The real question is, with slowing growth, rising costs, and changing consumer trends, is PepsiCo still a safe, long-term investment, or is it time to rethink? The first Pepsi soda was created in 1898 by a pharmacist in North Carolina, inspired by Coca-Cola's recent success. The drink quickly gained popularity, and in 1902, the Pepsi-Cola company was officially incorporated. Today, PepsiCo is a global leader in various snack and beverage categories and boasts more than 20 brands that each generate over $1 billion in sales, including Fritos, Gatorade, Mountain Dew, Quaker, Lay's, Cheetos, Bubly, Aquafina and Rockstar. The company is currently available with a 4.25% starting dividend yield, compared to its 5-year average of just 2.89%. The price-to-earnings ratio is currently only 16.8 versus the 5-year average of 23.7, while the sector average is around 17.8 at the moment. The stock price is currently near the bottom of its 52-week price range. The expected price range is estimated to be between $170 and $208, while the stock is currently trading at around $133, making it appear significantly undervalued. The company is currently paying an annual dividend of $5.69, distributed on a quarterly basis. The next dividend payment is scheduled for September 30th, and shareholders who own the stock by September 8th will be eligible to receive it. The most recent dividend increase was 5%, compared to a 5-year average of 7% and a 10-year average of 7.7%. Additionally, the company has been paying dividends for 60 years and has increased its dividend for 52 consecutive years. The earnings payout ratio fluctuates around 70%, and based on expectations, it is projected to be around 71% over the next 12 months. This is considered relatively high, but similar levels have occurred before without causing long-term issues for the company. However, it's worth noting that the company is paying out a higher percentage of earnings today than it did a decade ago, which could be a warning sign that future dividend increases may be smaller. The free cash flow payout ratio has also remained quite elevated for years. Looking at the earnings per share chart, it's clear that the company's growth has gradually slowed down, with a slight downward trend starting to emerge. Free cash flow per share has been stable around $5 for years without showing meaningful growth. Both the earnings per share and sales growth charts reflect this slowdown, but I wouldn't draw any long-term conclusions after just a few weaker years, especially with a company of this size. This could be a sign that there's limited room left for further growth, but it might also represent an excellent buying opportunity at current levels, especially with such a high dividend yield. The company maintains a regular share buyback program, which is a positive sign for long-term investors, just like the fact that total sales remains in an upward trend. Return on equity and return on invested capital have consistently exceeded expectations over the past decade. The operating margin chart, however, looks far less impressive and could still benefit from further optimization, especially as free cash flow margin is in a clear downward trend. While margins still exceed sector minimums for now, if this trend continues, it may not stay that way for long. As for debt, there are no major concerns. Management is careful not to overextend financially, and interest coverage remains comfortably above expectations, although it was somewhat volatile during the latter half of the 2010s. The company is currently available with a 4.25% starting dividend yield, which seems like a rare opportunity. The most recent dividend increase was 5%, and the company holds a strong A+ credit rating. The dividend also appears to be very safe, suggesting that the stock may be significantly undervalued at current levels. Disclaimer: this video is for informational and educational purposes only. It does not constitute financial advice. Always do your own research before making any investment decisions, and never base a financial decision solely on the content of this video. Q1 headline results. Revenue $17.9 billion, down 1.8% year over year. Core EPS $1.48, down 4% constant currency. GAAP EPS $1.33, down 10% year over year. Organic revenue growth plus 1.2%. CEO Ramon Laguarta highlighted that consumer demand remains subdued, supply chain costs are rising, and trade risks are growing. As a result, full-year EPS guidance was cut, now expecting flat EPS year over year, previously mid-single-digit growth. Dividend increased by 5%, continuing PepsiCo's 53rd consecutive annual increase. Where is PepsiCo growing and where is it struggling? PepsiCo Beverages North America plus 1%. Slight recovery. PepsiCo Foods North America minus 2%. Weak volumes. International Beverages franchise plus 7%. Solid growth, Europe, Middle East, Africa, plus 8%. Strong price mix, Latin America Foods, plus 3%. Rebound, Asia Pacific Foods, minus 1%. Flat slight decline. Operating profit weak in North America, stronger internationally. Cash flow from operating activities minus $973 million this quarter, seasonal but still weak. Dividend payout $1.88 billion in Q1. Debt. Long-term debt rose from $37.2 billion to $39.4 billion. What PepsiCo expects? Organic revenue, low single digits. Core EPS, flat versus 2024 FX headwind, approximately 3% drag on results. $8.6 billion total cash return to shareholders in 2025, of which $7.6 billion dividends. So, what's the takeaway? PepsiCo's 2025 story is simple. This is still a cash flow machine, still a dividend aristocrat, but it's not a growth story right now. North America is clearly struggling with soft demand and higher costs. Meanwhile, international markets are keeping the ship stable through price increases and better margins. PepsiCo's management is realistic. They're not promising fast growth, but they're delivering reliability through productivity initiatives and cost control. If you're here for dividends and stability, PepsiCo remains attractive. But if you're looking for fast earnings growth or exciting catalysts, this might not be your stock right now. Ultimately, PepsiCo continues to play defense well. Whether that's enough depends on your investing goals. Thanks for watching, and if you found value in today's video, give it a thumbs up and consider subscribing for more smart, long-term investing ideas. Stay patient, stay consistent, and keep building your path to financial freedom. Until next time, take care and happy investing.